Good morning everyone. Today's topic is on completing the audit. The definition on today's topic is, refer to those steps which are taken by the auditor, after the routine checking and verification of accounting record that has been completed. This enables him to wind up his examination and report. Under Section 167 CA 1965, an accounts are to be kept, as it will sufficiently explain the transactions and financial position of the company and enable true and fair profit and loss accounts and balance sheets and any documents required to be attached thereto to be prepared from time to time, and shall cause those records to be kept in such manner as to enable them to be conveniently and properly audited. First, the comparison of result of current year with information for prior periods, those anticipated in budgets or forecasts, other companies of comparable size in the same industry or overall industry or sector statistics. Second, consider relationship between actual and expectation, or predicted financial information, and also financial and non-financial information. Third, consider the reliability of the information used to perform analytical review procedures. Fourth, make a final assessment of the reasonableness of the company's accounting estimates. Lastly, to consider whether the accounting estimates are consistent with other audit evidence obtained. Next, let's see the going concern. It is the continuation of an entity as a going concern is assumed in financial reporting in the absence of significant information to the contrary. Ordinarily, information that significantly contradicts the going concern assumption relates to the entity's inability to continue to meet its obligations as they become due without substantial disposition of assets outside the ordinary course of business, restructuring of debt, externally forced revisions of its operations, or similar actions. Now, we're going to look into indicators that the going concern may be in doubt. In performing audit procedures such as those presented in paragraph .05, the auditor may identify information about certain conditions or events that, when considered in the aggregate, indicate there could be substantial doubt about the entity's ability to continue as a going concern for a reasonable period of time. The significance of such conditions and events will depend on the circumstances, and some may have significance only when viewed in conjunction with others. There are examples of such conditions and events: negative trends, for example, recurring operating losses, working capital deficiencies, negative cash flows from operating activities, and adverse key financial ratios. Other indications of possible financial difficulties, for example, default on loan or similar agreements, arrearages in dividends, and denial of usual trade credit from suppliers. Internal matters, for example, work stoppages or other labor difficulties, substantial dependence on the success of a particular project, and any other related example. External matters that have occurred, for example, legal proceedings, legislation, or similar matters that might jeopardize an entity's ability to operate, loss of a key franchise. Assessments of appropriateness of the going concern assumption. Compiled Auditing Standard ASA 570 going concern requires the auditor to consider the appropriateness of the director's use of the going concern assumption in the preparation of the financial report, and whether there are material uncertainties about the company's ability to continue as a going concern that need to be disclosed in the financial report. There are some implication on the auditor's report where there is doubt about the going concern assumption. The auditor may issue one of 5 possible audit opinions. In order of impact on the company, ranging from favorable to unfavorable, the auditor may: first, issue an unqualified opinion, then, issue a qualified opinion, and also issue an adverse opinion or issue a disclaimer of opinion.
Post-balance sheet events, contingencies and commitments. Post-balance sheet events. Those events, favorable or unfavorable, that occurs between the balance sheet date and the date on which the financial statement are authorized to issue. There are 2 categories: adjusting events and non-adjusting events. Adjusting events are those events which provide further evidence of conditions that existed at the balance sheet date. Non-adjusting events are indicative of conditions that arose subsequent to the balance sheet date. The auditor should perform the procedures designed to obtain sufficient audit evidence. All events up to the date of the auditor's report must require adjustments or disclosure in the financial statement have been identified. Subsequent events time dimension have 3 periods. Period 1, from year-end, during the fieldwork but before signing audit report. Period 2, from signing date to delivery of financial statement, and Period 3, after delivery the report. Period 1, auditors have a responsibility to perform procedure, to discover and evaluate all subsequent events that may have a material effect on the financial statements and make necessary adjustment or disclose in the financial state. Period 2, auditors have no responsibility to perform audit procedures. Auditors need to consider amendment if fact materially affected in the financial statement. Auditor need to perform additional audit procedures if management agree to amend financial statement. If management disagree, auditor should express qualified or adverse opinion. Period 3, auditors have no responsibility to perform audit procedures. If there is fact materially affected, the auditor need to consider revision, discussion, and take appropriate action with the management. There are 2 types of events. For adjusting event, the events will be adjusted and disclosed in the financial statement. For non-adjusting event, the events will be disclosed in the notes to the account. Audit procedures for subsequent events. Reviewing procedures management policies has established to ensure that subsequent events are identified. Reading minutes of meeting, review budget, cash flow forecasts and other. Management report, inquiring to lawyers, discuss with management on new capital commitment and borrowings, sales assets, issue new shares or debentures and asset damages. Also discuss includes contingent liability and capital commitment. Contingent liabilities is a potential future obligation to an outside party for an unknown amount arising from activities that have already taken place. There are 2 types. For possible obligation, it arises from past event which existence will be confirmed by the occurrence or non-occurrence of uncertain future events. For present obligation, it arises from past event but not recognized as liability. It is also not probable and cannot be measured. Audit procedures for contingent liabilities are as follow. It reads the minutes of meetings, BOD, shareholders, committee of board, and inquiries of management and lawyer. It reviews contracts, loan agreements, leases and correspondence. It reviews income tax liability, tax return and also inspect other documents for possible guarantees. Commitments is an agreement to commit the entity to a set of fixed conditions in the future, regardless of what happens to profits or the economy as a whole. Often enter into long-term contractual commitments to acquire capital assets such as plant and machinery, to purchase raw material or to sell their products at a fixed price. Such commitments are disclosed in the notes to the financial statements. Audit procedures for commitments. It is usually identified through inquiry of management and documentation. Opening balances and comparative figures. Opening balance refers to those account balances, which exist at the beginning of the period, closing balance of last period. The auditor should obtain sufficient evidence to ensure the opening balance do not contain misstatement that materially affect the current period's financial statement. Auditor should correctly brought forward figures and ensure appropriate accounting policies are consistently applied, accounted and disclosed. For AI 710, auditor ensure the financial reporting framework relevant to the financial statement being audited, and for FRS 101, amount will be disclosed according to previous period. When it is amended, comparative amount shall also be reclassified, and if impracticable to reclassify, entity should disclose the reason and the nature of adjustment.
Is an audit accounting estimates. The auditor should obtain audit evidence regarding accounting estimates. Accounting estimates means allowance to reduce inventory and receivable to their estimated value, depreciation or amortization, accrued revenue, deferred tax, provision for loss from lawsuit, and provision to meet warranty claim.
It is a management responsibility, which sometimes simple and sometimes complex. For examples, rental expenses is simple compared to estimating a provision for slow-moving inventories.
In audit procedures, the first step is the auditor must review and testing the process used by management. Next, the auditor need to evaluate the data and consider the assumptions used. After that, the auditor need to testing all the calculation. Lastly, auditor must make comparison between the current period estimate to the previous period.
The auditor also has responsibility to review subsequent event. Subsequent event may provide audit evidence regarding the accounting estimates made by management.
Standard requires the auditor to obtain appropriate representations from management, which can be by oral or letter in written. which also known as Management Representation Letter. Management Representation Letter is a letter from the management to confirm to the auditor that all information has been properly disclosed in the financial statement. The important purpose of management letter, firstly, is acknowledgement by the management its responsibility for the financial statement. Next, representation by management as audit evidence. Lastly, to conform the oral representation or documented the oral representation. The implication of contradictory evidence. If management refused to sign the letter, the auditor should constitute a scope limitation, issue a modified report to claim, if material is pervasive.
Next, related parties transactions. ISA 550 deals with the auditor's responsibilities regarding related party relationships and transactions when performing an audit of financial statements. Establishes outcome-based objectives, focusing on the auditor's responsibility to, first, to obtain an understanding of the entity's related party relationships and transactions sufficient, 2. Recognize fraud risk factors that are relevant to the identification and assessment of the risks of material misstatement due to fraud, and to conclude whether the financial statements achieve fair presentation or are not misleading. Audit procedures concerning related parties' relationship and related parties' transactions are considering both inquiry and inspection. First inquiry requires the auditor to make inquiries of management regarding the identity entities related parties, including changes from the prior period. Auditor may also make inquiries regarding the nature of the relationships between entity and related parties, and whether the entity entered into any transaction with the related parties during the year. Next, requires the auditor to make inquiries of management and others within the entity. Identify, account FOR, and disclosure related party relationship and transaction in accordance with the framework. Secondly, to authorize and approve significant transaction and arrangement with related parties. Next, requires the auditor to inquire of management regarding the nature of significant transactions outside the entity's normal course of business, and whether related parties could be involved. And for the inspection, it required the auditor to inspect bank and legal confirmation obtained as part of the auditor's procedure. Next, inspect the minutes of meeting of shareholder, and also other necessary records or documents. Thank you for your attention.